Because the reason all of us struggle, all of us, is because we're paid in an asset that the government steals back from us through inflation. Inflation is this myth. From 1776 to 1913, there was no inflation. In 1913, we created a central bank that then started systematically stealing half of our purchasing power every 30 years. It's crazy. And somehow we think that's good for us. Well, it's not. And so if you can convert that into something like Bitcoin for your savings, right? For your stay rich bucket, that makes all the sense in the world, because that's just going to accrete over time, because one Bitcoin will always be one Bitcoin. But we don't price Bitcoin in Bitcoin. We price Bitcoin in dollars or yen or euros. And those are going to continue to devalue as your Bitcoin will appreciate.
Mark Yusko makes one thing crystal clear. Bitcoin isn't just another asset, it's digital gold. Not in a metaphorical sense, but in its function, it's a modern store of value. Built for a digital age, where fiat currencies are quietly eroding your purchasing power through inflation. Yes, Bitcoin has massive upside, a potential 10x from current levels, but the real power lies in its ability to preserve wealth over time. In a world where money is being printed at record speed and traditional currencies are losing value by design, Bitcoin offers a powerful hedge, a lifeboat. And that's why understanding it now is critical, not just for high returns, but for long-term financial security. If you care about protecting your wealth, hit that like button, subscribe, and turn on notifications right now. We're diving deep into crypto, macro trends, and how to navigate this shifting economic landscape. Have questions or thoughts? Drop them in the comments. We read and respond to as many as we can. Thanks for watching. Now, let's jump in.
Bitcoin, it's digital gold. Like literally, it's like buying gold. And that's not going to give you a venture-like return. It could go up tenfold. I think it will go up tenfold from here, but it's going to take time. And then I think it'll go up another 10. So people say, well, that is a venture. No, what that is that's the devaluation of the fiat. Because the reason all of us struggle, all of us, is because we're paid in an asset that the government steals back from us through inflation. Inflation is this myth. From 1776 to 1913, there was no inflation. In 1913, we created a central bank that then started systematically stealing half of our purchasing power every 30 years. It's crazy. And somehow we think that's good for us. Well, it's not. And so if you can convert that into something like Bitcoin for your savings, right? For your stay rich bucket, that makes all the sense in the world, because that's just going to accrete over time, because one Bitcoin will always be one Bitcoin. But we don't price Bitcoin in Bitcoin. We price Bitcoin in dollars or yen or euros. And those are going to continue to devalue as your Bitcoin will appreciate. Now, you could say that about, well, people say, well, Ethereum's like that. It's like, no. Ethereum is a smart contract network. It's very different. Bitcoin is it's a store of value. It's proof of work, right? Just like gold, you got to mine it in the ground. So that can be a meaningful portion of your assets. But if you want to grow faster, then you got to look at things that are taking more risk, that are doing novel things. But now we get into tokenomics. If you invest in a project where the cash flows generated by that project are shared with the tokens, awesome, right? That's like owning a company. If you're in a token and the only way for it to go up is for someone else to buy it, it's a meme coin. So Doge comes to mind, or Shiba Inu. And you're like, but those are value. Like, no, they don't. I mean, they have value because Elon bought some Doge and tweeted about it, and everybody else bought it, and it went up. Great. But the problem is, if Cuban or Elon ever sold their wallet, the thing evaporates. It just evaporates. And so meme coins, they can work in a short term, but long term, what is there? Not a lot. Now, if you look at in between projects where you don't know the future, they're going to be volatile. Like, okay, I'm a board member of this company, Metaplanet. Metaplanet's been in the news last couple of days because it went crazy like this, and now it's down. And it's super volatile. Like literally the most volatile stock in Japan the last 3 days. All volatility, and people are like, oh, that's bad. No. Volatility is your edge. If you own an asset with no volatility, take T-bills, all that means is there's perfect certainty on future outcome. You know, in 91 days, you're going to get paid by the government and they've never defaulted. So there's no volatility. All volatility is uncertainty about future outcomes. Take Amazon stock. Amazon's been a public company 28 years. It has the same volatility as Bitcoin. 80. Every single year. In 28 years, it's had a double-digit drawdown. The average is 31%. Think about that, Abs. Every year, on average, you have the risk of losing 31% of your money. But when was the right time to sell? Never. But no one bought it 28 years ago and held it to today. Well, I say Jeff, mom, dad, ex-wife, Bill Miller. That's it. And so owning things that are volatile is how you win, but you want to own a portfolio of them that are uncorrelated with one another. So if you want to own some XRP and you want to own some Cardano and you want to own some Ethereum and you want to own some Solana and you want to own, those are in that category of people trying to build things. They're going to be volatile because there's uncertainty. No one knows if Swift is going to be replaced by Bitcoin, by XRP, by Cardano, I don't know. I mean, we don't know yet. And because we don't know, there are going to be some people say, well, I've done more work and I know more, so I'm more certain. Great. And there are going to be other people who've done no work and don't have any certainty at all. Those are the paper hands, right? And they're in and out and in and out. And that's what causes volatility. And so ultimately, I think everyone who's struggling to get ahead and struggling to make something should think strategically and critically about building a portfolio. Don't bet it all on one thing. Okay. Now, Mark, that's how everyone gets rich. True. All great fortunes, every single one, came from concentration. Okay. Concentration makes you rich. Yes. When history is written by the winners. Because for everyone who stayed concentrated and won the lottery, you got 99 that didn't, or 59 or 69, whatever the number is. And diversification keeps you rich. And you say, well, I'm not rich yet, so I want to get rich. Fine. Then be more concentrated. But for me, being super concentrated in one asset means you've got so much execution risk and technology risk. And it can work out, but the probability of it working out is lower.
Assets. In a market filled with noise and hype, that means owning assets like Ethereum, XRP, Cardano, or Solana only if you truly believe in their long-term value and you're prepared for the wild volatility that comes with it. The truth, the market hasn't chosen its winners yet. These assets could lead the next wave or they could fade away. That's the nature of early-stage investing, high risk, high potential. Yusko also shares timeless wisdom from legendary investor Julian Robertson, who mentored some of the greatest hedge fund managers of our time. His most important lesson: ideas are everywhere, but courage and conviction are rare. Anyone can have a good thesis, very few can act on it with unwavering confidence and long-term discipline. Let's go back to the interview.
This is a huge wealth creation opportunity. And we do say it all the time. You know, Web 1 created 2 trillion. Web 2 created 5 trillion. We do think Web 3 will create, 20-ish trillion because it's an exponential growth curve. So yeah, don't F this up. But to your point, definitely pick projects. Don't pick meme coins. Don't pick, if you want to gamble and speculate, knock yourself out. Like, I'm going to Vegas next week for BTC. I'm probably not going to gamble. A lot of people will. I like it sometimes, but most of it I don't really care about. But if that's what your thing is, great. My brother does it all the time. My brother bets on everything. And that's not bad or good. We're going to go play golf here in a little bit, and I'm probably going to have to bet him on our golf game, and I'm going to lose because he's a good golfer and I'm not. But you should do exactly as you say. Pick things you understand or you have knowledge, or people you know and trust have knowledge. And again, think about rebalancing, but maybe rebalancing is pressing your winners on occasion. Now, when things get crazy, don't be afraid to take some profits and to redeploy into something else. But if you're a true long-term investor, like if your time horizon is decades, don't look at it every day. If you're trying to make a bet for the rest of the day, like is the market going to open, is the market going to close up or down? You're going to make a bet, red or black, knock yourself out. But if you're buying something that you think is going to go from 200 billion to 5 trillion, why would you look at it every day? The average trader loses money. The average investor loses money because they buy something many times without a lot of knowledge. And when it drops, they want to prove they're right, so they buy more. Losers, average losers. Most times the market's right and you're wrong. Not every time, but most times. So Julian Robertson, who is a mentor of mine, famous hedge fund manager, and I talked to all these people that work for Julian, and they're all super successful. In fact, the people that worked for Julian managed 10% of all the long short money in the world. It's pretty amazing. And I asked him all this. I asked him, what made Julian so great? I'm like, so many things. He's a man of integrity. He had, courage of his convictions, because courage is really, really important in investing. Great ideas are plentiful. Courage is rare. But what really made him the best was they said he had an uncanny ability to double up. So you spread your bets out. The things that start to go against you, you just sell them and move on. But the things that start to work, you actually buy more. And you say, Mark, that's counterintuitive. You studied under Dr. Markowitz, and he said you should rebalance. Yes, when you're wealthy. When you're wealthy, rebalancing is a way better strategy to stay rich. Diversification and rebalancing keep you rich. But that ability to have confidence in the winners and double up, not based on faith, but based on knowledge and execution and research and data, that's a rare skill. So anyway, that's a lot of talk. The problem with technology, opportunity. The opportunity with technology is determining when technology gets outcompeted. Ethereum's a great example. So look, we were early ETH investors. We made nice returns in Ethereum. But here's the problem. We've sold almost all of it. Now, why? It's not because we think the people working on it are bad. It's not because we think, the new upgrade is a dumb idea. It's simple question I keep asking is, if Ethereum was invented today, would anybody use it? And I think the answer is probably not. Why? Well, because other people looked at Ethereum and said, it's good, but I can make it better. I can make it faster. I can make it cheaper. I can make it more secure. But Mark, all the developer activities in Ethereum. Yes, that is true. Bigger than most, but that's because the installed base is really big. They were first.
One of Julian Robertson's greatest strengths, and a trait shared by elite investors, was his ability to double down on winners. But not out of emotion or FOMO, he did it based on data, execution, and conviction. It's a strategy that often defies conventional wisdom and modern portfolio theory. Yet it's how some of the greatest fortunes in history were built. Mark Yusko takes a philosophy to heart. He urges investors to rebalance with strategy, not emotion. That might mean taking profits when an asset goes parabolic and reallocating to more promising or undervalued opportunities. It's not about chasing hype, it's about positioning for sustainable, long-term growth. But the biggest mistake, obsessing over your portfolio every single day. Long-term investing is a marathon. It demands patience, resilience, and trust in your thesis, not reactionary behavior every time the market wiggles. If you're serious about building real wealth, hit that like button, subscribe, and turn on notifications so you never miss insights like this. We break down what actually works beyond the noise. And don't stop here. Check out more videos on our channel to keep leveling up your strategy and mindset in crypto, macro, and beyond. Got thoughts or experiences to share? Drop them in the comments. We're building a smarter community together. See you on next video.